This is Business Weekend with Ross Greenwood.
Hi there and welcome to Business Weekend. I'm Ross Greenwood. It is great to have your company today. The world, we all know it, is changing rapidly, and it's largely the result of Donald Trump's policies plus the speed of his execution. Australia, though, is not changing quickly enough to adapt, and our economy risks being left behind. Our special guest today is Richard Quest, the CNN anchor and business editor-at-large, who over the years has interviewed many of the world's economic and business leaders. He, I think, might have a different view. The Australian stock market this week hit new all-time highs as company profits drove it higher. One of those, BHP, off the back of its copper interests. And we speak with its Australian president, Geraldine Slattery.
Copper, we've said for a long time now, is central to that, both in terms of core economic growth, so conventional demand, but also electrification.
And there is good news this week. APA Group, which owns Australia's gas pipeline network, says the East Coast will not suffer from gas shortages in the next 2 years as forecast because of new investments it's now signing off on. We speak with APA's Adam Watson.
So we've been working on a solution to try and bring the abundance of northern gas supply from places like the Beetaloo, from the Bowen, from the Surat, down to the southern markets.
Also on the program, Santos CEO Kevin Gallagher, after the company said it will cut staff by 10%. And ACCC Chair Gina Cass-Gottlieb with a warning to all companies that customers are losing trust in the way goods are priced.
That businesses don't, of their own volition, do the right thing, but need to be compelled to do so, that there is not an earning of trust.
But look, we should start with the shock ruling from the US Supreme Court on Friday night, our time, that effectively makes $133 billion US worth of Donald Trump's tariffs illegal.
The Supreme Court's ruling on tariffs is deeply disappointing, and I'm ashamed of certain members of the court, absolutely ashamed, for not having the courage to do what's right for our country.
There is almost no doubt it will throw global trade into turmoil. Already, importers into the US have started legal action to get back the money they've already paid.
I expect the government to give me my money back with interest. And as soon as they do, we'll start spending it. So, because that's what we do. And right now, I'm trying to guide the company back to normalcy.
But Donald Trump immediately hit back and signed an order to impose a new tariff, but under a different authority.
Today, I will sign an order to impose a 10% global tariff under Section 122, over and above our normal tariffs already being charged. Foreign countries that have been ripping us off for years are ecstatic. They're so happy. And they're dancing in the streets, but they won't be dancing for long, that I can assure you.
But look, there is still that question. What happens to the money the US has already collected?
Very fair question. They take months and months to write an opinion, and they don't even discuss that point. We've taken in hundreds of billions of dollars, not millions, hundreds of billions of dollars. And so I said, well, what happens to all the money that we took in? It wasn't discussed. Wouldn't you think they would have put one sentence in there saying that keep the money or don't keep the money, right? I guess it has to get litigated for the next 2 years.
Now, though Australian companies were not hit with the size of tariffs that others in Europe, Canada and China were, the 10% general tariff could have collected up to $1.4 billion from Australians. That's according to EY Australia. Now, on Friday ahead of this ruling, coincidentally, I spoke with CNN's news anchor and business editor-at-large, Richard Quest, and I did ask him whether Trump ultimately will be seen as being an agent for change.
Hang on a second. You use this phrase, the global...
agent for change.
Agent for change. But a ball and chain on a wrecking ball is also an agent for change. The issue is not whether or not change was necessary or change is desirable. It's the manner in which it was done. Is it correct to basically offend all your trading partners, to try and rewrite the global trading rules, when the WTO, World Trade Organization, tells us that 75% of world trade is still done on their terms. So you know, the hoopla and the noise vis-a-vis the real change taking place, vis-a-vis the angst, anguish and annoyance, I don't think we know yet.
All right, so but the fact of the matter is that the notion of an America which is more self-reliant and that the world is not relying on the goodwill of America.
Correct.
That is a fundamental change.
Correct.
The Europeans now have to stand on their own 2 feet more than before. The question is whether future administrations try and roll this back, or whether this is something that is for the long term.
Well, I mean, it's a very interesting point, because we just don't know. What we can do is look back at previous changes of administration. So, for instance, when there was the change from Trump 1 to Biden, Biden did not roll back all the tariffs that Trump had done on places like China. He kept most of them. Many of the changes were kept. If Donald Trump he's going to go the full 4 years, and a lot of these changes have been made in year 1, they are embedded by year 4. Is it reasonable to change them if there's a change in administration? Probably not.
But you see some resistance coming. Mark Carney in Canada. You see the German Chancellor now starting to push back at Donald Trump. It's not as though this is all one-way traffic and they're just simply copying what the US president dishes out.
No, but what Carney said in his Davos speech is that Donald Trump was essentially changing the rules of the game in the middle of the game and doing it unilaterally, and that the system now everybody had to adapt. And Carney uses the phrase variable realities or something, where he's saying that countries, middle power countries, Australia, the UK and the like, are going to have to find allies based on individual reasons. No longer will it be, well, we all think the same. Well, Anglo-American background. Well, no. You might be with that lot over here on that reason, that lot over here for that reason, and a completely different group. And that's the future. And Donald Trump has forced it on the world.
OK, so this all happens at the same time that one of the greatest changes in our economy, which is generative artificial intelligence, is also coming. GPU chips.
Right.
Taiwan plays such a crucial part of this. So the relationship between China, the US and Taiwan becomes pivotal in this whole conversation.
Of course it does. But Donald Trump seems happy to have arguments with both. He's gone against Taiwan over chips. He has not given it the same security guarantees as before, and he's gone against China over the cost of a whole range of trade issues. Where does the US policy lie? We don't really know, because it is dependent not on process, but on personality of the president.
OK, so then there's another part of it.
I feel in this, you're forcing me down a funnel.
Which funnel?
The funnel of attacking the policies of the president.
No.
A sense, because there's clearly change needed to happen.
That's my
Europe,
point.
for example, needed to rethink its defence strategy. But do you need, never mind throw the baby out with the bathwater, do you need to demolish the bathroom and rip out the plumbing at the same time?
But it would be fair to say that tax policy, energy policy, industrial relations policy in the United States is more pro-growth now. There is productivity gains there that there is not, say, for example, in a country such as Australia. To my point, if you do nothing as a government or little as a government, you do need to make change to keep up with the rest of the world.
No, that's a fallacy. And I'll tell you why. Because, yes, if you go hell for leather for growth, if you start getting rid of established science, if you start changing the climate rules as they did, as you'll know, just 2 weeks ago, you will get more growth. I promise you, Ross, it's not difficult to get growth. You can put the economy on steroids very easily, but there will be a cost. It will be an environmental cost. It will be a labour standards cost. It will have a cost.
Everything has a cost, of course. This is the issue. But the question is about whether countries such as Australia, as you say, need to pick their allies and pick their fights. But the fact of the matter is countries themselves need to find their productivity. They need to find industry. They need to make that industry competitive.
Oh, yeah, but everybody can agree with that. That's a truism. What they have to do is they have to do all of that within the framework of ensuring that you don't destroy the planet at the same time, within the framework of good-paying jobs. Look, I know I was learning about, over this week, the cost of the wages given to a server.
Yes.
Which, of course, in New York would be minimum wage, and it would be tips, if that. Here it's $35 an hour, double or whatever it is on holiday.
The average wage in Australia now over $100,000, which give or take is the best part of $66,000 US.
And what's your problem with that?
I've no problem with it. It's simply the cost of doing business. If you're a business, that makes it harder to make a profit, especially if your taxes are higher, especially if your energy costs are three times the cost of the United States.
But the danger in Australia is that the unspoken social contract that existed is breached. And people say, hang on, we didn't have this, or we paid higher taxes, or we did this because we decided we wanted a better way of life and we wanted a better social safety net. That's the...
On this subject, final question for you.
Go on.
Will the next generation be better off than their parents?
You know the answer to that. The answer's no. No.
Is that
our generation and the generation probably after, we were the last ones. We were probably the... Look, it's a mass generalisation, and you
yes,
know
I recognise.
And the whole audience is throwing things at the screen. But the probable reality is that the next generation, because of inflation, because of the cost of housing and all these other reasons, because of AI that'll put people out of jobs, no, we've seen the best of it to a large extent.
All right. Now, apart from doing business economics for CNN, you also travel.
I was enjoying myself until I sat down here. Carry on.
This is the style of the conversation.
Go on.
You also do travel and aviation as your speciality. Qantas has its new Operation Sunrise coming in, direct flights from Sydney, Melbourne to New York or to London.
Correct.
Would you fly on those flights?
Yes, why not? I know the argument that you are all going to say is, oh no, I don't want to be stuck on a metal tube for 19 hours. Oh no, I want to get out of the street. I guarantee you,
I think
that when business travellers come to make the choice, do you want to do it in 19 hours and get it over and done with, or do you want to do it in 35 hours or 27 hours? I know where the answer will be. The Perth non-stop shows it. There is a 20% premium on that flight because it's faster.
Richard Quest, it is lovely to catch up with you.
The only question I would ask you...
Yes, one question.
I suspect you and I will be on that first flight in some shape or form.
I would hope so. I think that's inevitable.
Would you take that first flight if it was at the back in economy? And with that, we thank you for your company.
Yes, thanks so much. After the break, the big Australian is back. BHP shares hit a record this week, plus ACCC boss Gina Cass-Gottlieb with a warning for all companies: get your pricing right or we'll come after you. It's great to have your company here on Business Weekend. Well, for more than a decade, BHP has had a consistent strategy that's driven its mines and its investments. That fundamental core is about rising population, increased urbanisation and electrification. That led BHP to become the largest copper miner and producer in the world. So as copper prices grew almost 25% in the past year, BHP's profits soared, and copper contributed more for the very first time than iron ore. This week, I spoke with BHP Australia's president, Geraldine Slattery.
So, Ross, part of the core strategy at BHP is looking at the trends that are underpinning the future of population, the future of the economies. And copper, we've said for a long time now, is central to that, both in terms of core economic growth, so conventional demand, but also electrification, and increasingly, as we've seen in the last couple of years, is the copper that will be needed to underpin artificial intelligence and the digital transformation. So we've increased our copper production production through organic and inorganic investments over the past number of years, so 30% up over the past 4 years. From here, the story arguably gets even more exciting. So attributable copper production today, 2 million tonnes. We see a pathway through to the mid of next decade to 2.5 million tonnes. And that essentially comes from four big opportunities that we have in the portfolio and understand today. Here in Australia, in South Australia, where you've got a pretty credible polymetallic opportunity, so very, very rich in copper. Today, that's a top 15 producer. And then 3 other opportunities, 2 in South America, Escondida, part of the biggest copper mine in the world, and the growth expansion there. Vicuña, which is a new addition to the portfolio quite recently, and then the Resolution copper mine in North America. So, as you said, really strong earnings in this half from the appreciation in price, which we did anticipate, but also the performance in the assets. And yeah, super excited about what's before us.
Okay, but I want to know whether the world is now still short of copper. Copper's price, for example, has gone ballistic over the past 12 months or so, off the back of this shortage, a lack of mining, a lack of refining. Is that going to be satiated anytime soon?
So by our maths, we see the global copper demand going from 30 million tonnes, to give this a sense of scale, 30 million tonnes in the early 20s to 50 million tonnes by 2050. And when we take account of new mines coming into supply and growing demand, growth from existing mines, we still see a deficit of 10 million tonnes that has yet to be found and sanctioned and capitalized through to 2035. So in simple terms, what you see is this structural deficit opening up in the market, which of course positions our assets, our portfolio of assets and growth options really well to take advantage of what we see as structural underpinnings to stronger pricing.
Because I know in speaking to Mike Henry in the past, it was often a case of wondering whether you develop Olympic Dam, or whether you develop assets in Peru, or whether you develop assets in Chile, or whether you go to Canada. Now it could be very much the case that all of those, because of the copper price, are very much open for development. Is there enough capital there to be able to pursue all of those opportunities?
So you mentioned potash there, and another part, just to set the scene for the strategy in the portfolio, is copper is one core component of it, but we also recognise that population will continue to grow, and the demand for more efficient arable land and the production of food is something that will continue to appreciate over time. So as well as growth in copper, we anticipate growth in demand for fertilisers, and potash being integral to that. And we'll see our potash mine in Canada coming into production from next year. Back to the balance sheet and our ability to capitalise both copper growth and potash growth. So we have a balance sheet that we manage very, very rigorously from a net debt perspective and from our affordability perspective. And so where you see the results in this half year, you see our net debt kind of very comfortably in the middle of the range. You see strong returns to shareholders, and you see continued investment in sustaining and major growth. So the opportunity for us now is unlocking that growth, progressing the studies and the permitting and the approvals. So it's less a question of capital and more a question of arriving at the right development sequence, working with our partners, working with governments, working on the development plans to progress these over time. And to bring it to life here in Australia, in South Australia, the part of the investment going forward that underpins the unlocking of that whole basin is a decision on a bigger smelter that will unlock the potential of that basin, and we anticipate that will happen through the next calendar year.
Okay, one other big theme for BHP has always been urbanisation, and that largely has been centred on China, to a lesser extent on India. But the urbanisation story of China is seen to be now a mature story. It was leading to questions about the future price of iron ore, but now you've got record output, you've had pretty strong prices during this last half year. That seems to be now an ongoing story rather than maybe a diminishing story.
So iron ore prices have been resilient over the course of the past year, and I think probably on the upside of most predictions would say this time last year, and that's underpinned by just continued resilient demand from China, which is the largest consumer of iron ore. We continue to see 1 billion tonnes a year of steel coming out of China, very competitive on the export side of that. From China continues to be very competitive, but also underpinned by continued strength in the transport and the machinery sector within China. So whilst we've seen softness in the housing market, that's been offset by exports and by machinery and transport. Bring that back into the supply side. Whilst we've seen continued growth in supply, we have seen that resilience. Now, when we look forward, we do see that steel demand and iron ore demand will start to plateau over time. We've anticipated this. This has long been in our strategy for the iron ore asset in Western Australia, which we have positioned structurally to be very low on the cost curve to protect our margins. So resilient, but we anticipate that we will see that moderate over time.
Just one final one for you, and that is your costs. Quite clearly, in this half at least anyway, the price gains for copper in particular were much greater than your costs were rising. But I just wonder about the wage claims in Western Australia. That's been one issue, but you've said they've moderated. So does that suggest that BHP's objection to the industry-wide bargaining, which you really fought aggressively against the government of, maybe was overplayed?
So we have in the half-year results spoken about how the cost of labour has normalised. That's very much here in the present today. The points that we have raised, and indeed would continue to have conviction on, is that the changes to the Fair Work Act, which essentially seeks to challenge the notion of enterprise bargaining, that core relationship between employees and management, which have served both the iron ore sector, but the community and the economy more broadly really, really strongly, is that link between productivity and reward, and the link between people being able to engage directly with the enterprise to negotiate terms. That's where you see an erosion of flexibility and the installation of drivers which don't necessarily reflect employee interests or enterprise interests. So I would certainly stand by the concerns that we've raised, and not to be confused with the changes or the drop in inflation that we've seen quite recently.
Geraldine Slattery, good to chat to you today. Many thanks for your time.
Thank you, Ross.
Competition watchdog, the ACCC, is right now in the middle of a groundbreaking legal clash with the supermarket giant Coles. It says Coles created false specials by suddenly raising prices for short periods, then creating specials from those inflated prices. And though ACCC Chair Gina Cass-Gottlieb won't talk about that case, the agency's annual compliance and enforcement priorities makes plenty of references to the need for consumers to have trust in prices. I spoke with Gina Cass-Gottlieb this week and just asked her about what she sees as consumers' declining trust in companies.
We are, as a competition and consumer protection regulator, wanting to draw out that we need both competition and the conditions in which consumers can trust and be confident to participate in the economy. We are very concerned that there's declining trust, and that in circumstances where consumers know they have to complain to receive basic rights, that businesses don't of their own volition do the right thing but need to be compelled to do so, that there is not an earning of trust. So for an earning of trust, we need a shared understanding between the business community and the consumer community about the expectations of business conduct and the standards, and that the ACCC plays this critical role in setting clear standards, in monitoring them, and then enforcing when we see there's evidence that they are not being complied with, because we will hold businesses accountable. And with accountability, there will be an increase in trust when consumers then are confident to purchase, to adapt new products and technologies, and to be bold in the way in which they engage in markets. Without that, we can't take the steps that we need in terms of a more resilient and productive economy.
The categories of business that you have identified for these compliance and enforcement priorities include things that consumers use the whole time. It's aviation, so airlines we're talking about. It's retailers, so supermarkets, big retailers. It's digital businesses, which is kind of interesting as well. So I just want to go to their mainstays. It's also energy companies was the other one that's on your list. They're mainstays of everybody's lives, and surely they would, you'd imagine, try to be upholding their own reputations and not be sullied by being caught out in some way by the ACCC.
In many ways, what are common features between these businesses is they're large, they're in concentrated sectors, so they have a degree of market power. Also, when you look at the essential services, which is necessary to enable every household to cook, be warm, travel, feed the family, you are seeing quite a lot of complexity in the way offers are put to consumers. You particularly see that telco, electricity and gas. So it's very difficult for consumers and small businesses as well to compare, to understand where their best deal is that will meet their needs and give them savings.
But I would have thought in the digital world that we have, it would be easier to compare. We have comparison services. We have AI that can help us try and compare the various things. You say there's still a degree of confusion, though, and that the companies take advantage of the confused consumer's mind.
The fascinating thing about AI and all of these systems is that they are only as good as the data on which they're based. So the data has to be accurate, and also that it is presented to consumers in an accessible, understandable way. One of the ways that we are seeing in this digital environment is that we are absolutely deluged with a huge amount of data and very difficult for consumers to work out. I could take a simple example for you, purchasing bananas or cucumbers in the supermarket. If one part is by bunch and the other part is by kilos, you can't actually compare the price and work out what is. It's a simple product, it's a simple situation, but you cannot compare and work out what is the best deal for your family. You have that replete when you have multiple complex offers from an electricity company, even comparing to work out what's the best offer from your existing company, let alone to compare to another. So we need good data. We need a focus on not being misleading by deluging everyone, but actually giving the data that matters and that is clear. There's a lot of work to be done, which we are doing to set out clear standards of behaviour so that consumers can actually use technology and make meaningful comparisons.
But I would have thought that the Royal Commission into banks that we had would have been the clear lesson to all business that they have to be extremely careful in putting their own commercial interest ahead of the consumer's interest, that the two should be hand in glove, as it were.
I'll give you another comparison, Ross. A number of years ago, the ACCC had a very important win and penalty against Telstra for misleading and unconscionable conduct in relation to Aboriginal and Indigenous customers. Go forward a few years, Optus, same sector, engaged in similarly unacceptable behaviour in relation to Aboriginal and Indigenous Torres Strait Islander customers. So you have a situation in which you would say, shouldn't companies learn? But if a company does not have hardwired into its business structures compliance approaches, if the remuneration is not focused also on compliance, particularly when engaging with vulnerable customers, and is solely focused on sales and sales revenue, you will continue to have poor behaviour. It requires a deliberate intent to comply with the law, and we are looking for accountability and responsibility from businesses and senior managers in businesses to ensure compliance with these basic rights under the Australian Consumer Law.
And as the chair of the ACCC, to those companies or individuals within companies who may choose to take that path that you talk about in terms of pricing, in terms of taking advantage of their customers, What's your message to them?
We will take action against you where there is evidence of harm. They're two good examples of evidence of serious harm. Where there is evidence of harm, we will take action.
Jenna Cascott-Lee, always good to chat to you. Many thanks.
It's a pleasure.
Up next, two of Australia's energy giants, Santos Chief Executive Kevin Gallagher after announcing a 10% staff cut, and Gas Pipeline Group Chief Executive Adam Watson. Thanks very much for being with us here on Business Weekend. Well, Santos is a company which polarises many Australians. The company has a rich history, and its achievement to bring gas to Adelaide, Brisbane and Sydney through its Moomba plant in the Cooper Basin should never be understated. But the company's shares really haven't performed for the past 5 years. A $36 billion takeover bid last year evaporated. Now CEO Kevin Gallagher is determined to cut costs and to pursue projects that achieve better returns, even if that means selling off legacy assets. And I spoke with him about it this week.
Well, I'm not going to make any predictions, Ross, on how long I'll be around for. But first of all, let me just address the 2 points you've raised. First of all, the strategic review of our integrated Australian oil and gas assets is really as a consequence of us delivering on our two major growth projects, the Barossa project and the Pikka project. And as they come online and ramp up to full production this year, that really positions Santos now as having three world-class Tier 1 assets in its portfolio: PNG, Alaska, and of course our Barossa project here in Australia. That's 60% of our revenue or our production going forward is coming from those LNG assets, 20% out of Alaska, and 20% from that remaining Australia oil and gas integrated portfolio. And all we're really saying is that given that we have so many world-class opportunities in the future for more growth around those assets, those Tier 1 assets, we really want to do a review of the Australian integrated portfolio to see what screens and what doesn't screen going forward, what fits and what can meet those new higher hurdles, if you like, to compete for capital across the portfolio. Because we will be limited to invest based on our capital allocation framework. And that's a discipline we like across the business, but it's really just looking at what fits, what doesn't fit, and then looking at what we should do with that portfolio. So in terms of the headcount reductions, it's all I was going to say, in terms of the headcount reductions, it's really just mainly a consequence of major projects rolling off.
OK, so let's go to the first part of that. Does that mean that potentially Santos could see itself exit some of its key assets in Australia? I'm thinking the Cooper Basin and the Moomba gas plant. Does that mean some of your assets in the northwest of Australia could potentially go as part of this review? And is it really about trying to find other assets that may grow faster than what those assets could grow in the future?
Look, it's wide-ranging. I mean, I'd even add to that, even within those assets you're talking about, there might be subsets of assets that can go even faster, that fit and meet those higher economic hurdles in order to win that race for capital. I'm not going to speculate on what the outcomes will be. We advised the market this morning that we'll give an update on that to the market at our Investor Day in early May. But it's wide-ranging. Nothing's off the table. There's nothing specific we're trying to signal from it. It's really just an economic strategic review of that part of our portfolio to see what fits, what doesn't fit, what can be accelerated, and maybe what should be discarded. Who knows? We'll wait and see what the review. The only people that actually know what it looks like are the people doing the review right now. But we'll be able to share more of that with the market and broader audiences in early May.
Is a part of this trying to bring down your cash flow break-even cost, which you put today in your annual report as $58.90 per barrel? You've indicated that by 2030 you want that down between $45 and $50 per barrel. Is that trying to, A, discard, sort of, if you like, lower, less profitable operations that you have, but also bring in more profitable operations like Barossa, like Pikka that you've got in Alaska?
Well, it's definitely about prioritising more profitable operations and more profitable assets, that's for sure. And yes, we want to keep looking at putting downward pressure on those break-even prices. But just to clarify, Ross, the 45 to 50 all-in free cash flow break-even is from this year to 2030. We are targeting being within that range in 26, 27, 28, 29 and 2030, despite whatever activity we have going on. You know, that includes things like Papua, LNG and PNG. We will be in that 45 to 50 range over that period. And that's a constraint, if you like, that we put on the business, a very deliberate bit of discipline in terms of our capital allocation framework. So we're already there. But your first point is absolutely correct. It's about prioritising the more profitable over the less profitable and freeing up capital to put into those better projects.
OK, can I just ask you about the departure of your former Chief Financial Officer, Sherry Dewey, last year? Now, as she left, she also made very public comments about culture inside Santos. What I wonder is if you've just announced you're going to cut 10% of the staff numbers at Santos, whether that's going to improve culture inside the organisation.
Well, look, I think, first of all, the point to culture being impacted by the headcount reductions, we staff up to build these projects, and we fully expect that when these projects come off, that the project personnel, the staff were brought into the organisation, will roll off. And they typically are more nomadic workforce than our core operations workforce who are with us all the time. And so it's really just demonstrating to the market that as these projects finish, we expect the temporary organisation that we've built around these projects to roll off. I don't think that'll have any material impact on our culture. And what I can say is every year we do perform culture surveys here at Santos. And our last year's survey, for example, towards the end of the year, had an incredibly high participation level of around 84%. Our engagement was record levels, top quartile worldwide. And confidence in leadership, alignment with strategy, safety culture, and one that's very important to all of us is the confidence to speak up. Those scores were all very high, all top quartile. So we're very confident we're heading the right direction in terms of culture. There's always more you can do. There'll always be some disillusioned employees. That's life. But we listen to our people and we react to that, and we try to improve the culture here at Santos year on year.
OK, so part of the strategy that you've got for addressing the assets, looking at the costs of the business, are also about a share price which really has gone nowhere in the past 5 years. Partly commodity prices, but really it's also about having the right assets at the right time. The Abu Dhabi National Oil Company walked away from a takeover last year. This is about trying to get that share price moving again.
Well, obviously, I mean, our ultimate aim is to drive share price up and drive improvements and returns to shareholders through the cycle. And what I would say, if you look at our operating model for over that 5-6 year period you're talking about, we had great share price growth from 16 through to 20, and you're right, it's been stagnant ever since. And during that period, although production's been pretty flat, our share price has really reflected that because we did not grow production during that period. But what we did do in that period was drive our production costs down, our unit production costs down, to create more margin in our barrels, and to the lowest production cost in 10 years at Santos. And that's allowed us to free up more free cash flow generation from the portfolio, which has allowed us over that period to grow the dividends to our shareholders with a compound annual growth rate of over 20% for that 5-year period alone. And in addition to all of that, we've done all of that, and at the same time improving our safety performance and reducing our emissions to the point where we've actually hit our 2030 emissions targets 5 years early.
Good to chat to you. Many thanks for your time today.
Thanks, Ross. It's a pleasure.
But Santos and its gas reserves would be nothing without the APA Group. The biggest owner of gas pipelines in Australia is a key part of the solution to forecast energy shortfalls. Finally, it seems government understands it needs to act to clear the way if those shortfalls are to be avoided. This week, I spoke with APA Group Chief Executive Adam Watson on why his company is investing hundreds of millions of dollars to create new pipeline capacity to avert those shortfalls.
The short answer is yes, it does. It addresses that bottleneck that we knew existed in being able to bring northern gas supply to the southern demand centres. We know that we've got southern gas supply drying up, essentially, the Bass Strait gas that we've all been familiar with. And it's not to say it's going tomorrow, but it is reducing in supply over time. So we've been working on a solution to try and bring the abundance of northern gas supply from places like the Beetaloo, from the Bowen, from the Surat, down to the southern markets. So we've expanded that through 2 stages. We've done that through compression, which is effectively building more capacity on your existing network. It's a very efficient way to bring more volume down, utilising the existing pipeline network. But equally, we're building a new pipeline called the Blue Interlink. And again, that's really designed to bring gas from the Bowen and from the Surat down to the Victorian markets.
Okay, so is that enough, do you believe, to take pressure off gas prices and therefore electricity prices in the future?
Yes, it is. It's designed to address the currently forecast winter 2028 shortfall into Victoria, so we address that. And then beyond that, we've got more capacity coming online through incremental compression, which effectively addresses those long-term forecasts into the 2030. But in short, we've now got the pipeline capacity that addresses all of those capacity constraints. We've got the domestic gas supply. This enables us to allow the federal government's National Gas Review to come alive, to bring domestic gas supply to domestic consumers.
Because the compression also overcomes another issue that you have always faced, and that is the Land and Environment Court, and basically being held up for years in those courts when you've wanted to actually put in new pipelines.
It's a good observation, and the compressors are on reasonably small footprints. And I always describe it like your garden hose. You turn your tap on and a little bit of water comes out, but your hose is full. Our pipelines are full, but we're trying to get more pressure to push more molecules out of those pipes. So we use the compressors to do that, and you can build them out incrementally. Then when you look at the Blue Interlink, we've already got that corridor in place. We've been working with landholders, traditional owners, so we have the ability to be able to move that through quickly. Similarly, with new developments like the Beetaloo, which we're excited by, we've got existing pipeline routes, and we're trying to use those pipeline routes to build out the additional pipelines required to bring that gas to life, whether it be to the domestic market or export. And it's just a very neat way to be able to work with those existing landholders.
Okay, so apart from the Surat and obviously the Bowen basins, which are big reservoirs, there's also the fact that the Beetaloo is seen to be the real answer to long-term supply issues. But it needs some key decisions, pipeline decisions, to be made before that can actually hit either export markets or indeed the local markets as well.
And it's important to note that we don't actually need the Beetaloo to support domestic gas supply in Australia. We do have enough in the Bowen and in the Surat and in the existing basins. So Beetaloo, as I describe it, is really cream on top for the domestic market, as it will bring more domestic gas supply to market, which can only be good for pricing. But Beetaloo being such a significant resource, hopefully a significant reserve, is really going to be an export market. And we're working on 2 principal type pipeline routes. One is to take that gas from the basin east, and it makes a lot of sense to go through the Gladstone existing LNG facilities as they start to wind down their production in the early 2030s to mid-2030s. They could bring Beetaloo gas on to export gas out to our Asian partners as they currently do. But it can also go north up through Darwin and equally be exported to our Asian partners through Darwin. So one of the really amazing things about the Beetaloo is its size, its flow rates, its production rates are phenomenal from what we've seen in the early days, which means pricing should be good. It's low emissions, so it's going to be really attractive for the export market.
Okay, so who makes that decision as to whether that gas heads to Gladstone or goes to Darwin?
It'll be producer-led. Customer demand, people in Asia, people in Japan sitting there saying, I want your molecule, they're not really going to mind whether it comes from Gladstone or whether it'll come from Darwin. They just want the molecules. So it's really who's going to be prepared to go first to bring that production to market and to make sure that we've got enough LNG train capacity to be able to export it. That seems to already exist in Gladstone, in the Queensland area. Some additional capacity would be required up in Darwin, but there's enough production, there's enough supply there to service both of those. So it's early days, but my prediction would be that it's going to go out of both markets.
Okay, take me now to the government policy now to reserve gas, to preserve it for the local market before export markets are satisfied. What does that do in terms of your business, in terms of a pipeline business?
I'd like to start by saying our state governments, in particular, the ones that we're talking about, Queensland the Northern Territory have been incredibly good, incredibly proactive at making sure that they're bringing that supply to market. And you mentioned it before, making sure that we've got good processes in place to protect our landholders, traditional owners, but also providing mechanisms that enable us to move forward in those discussions, which has been really good, and it's bringing it to life. We can see it now. It works the same for us. It's making sure that we've got good policy in place to provide certainty for the customer, in particular in the domestic market, the end users. So the end users need certainty on what's the price cap going to be? What's the level of reservation going to be? Is it going to be capacity constrained, or are you going to try to promote the domestic market? And what we're really encouraged by with the National Gas Review, which came out in draft late last year, is that it's all about domestic gas. They're talking about making sure that the gas is not just available for use, that it's actually put into the market for use. We think that's a really important piece of the puzzle that needed to be solved, and really there to spur domestic supply, which will help pricing in the long term.
Okay, so was it that gas review which gave you the confidence to spend the money to basically get these new compression projects, these new pipeline projects, to commit to those, knowing that you've still got to get a return for your shareholders?
It was certainly a big part of the decision making for us, is we needed that confidence. And to be honest, it's got to be customer-led, and we, speaking with our customers, we're also sitting there saying, well, we need this National Gas Review to play out the way that it should, which, again, the government's done a really good job in getting to that point now. We had favourable regulatory outcome as well in terms of the greenfields exemption and being able to bring this to life. And ultimately what we're looking for as an industry, because industry's there to bring it to life, you just need policies, roadmaps, the green lights, the runways to be able to get on with it and give the customers confidence to procure and to give the suppliers confidence to supply.
Does all of this mean that your natural competitor, which are importers of West Australian gas into the east coast of Australia, which we really haven't seen happen to this stage, a lot of people think it's obvious, but these types of developments means it's harder for those types of projects to be commercially viable in the future?
It's economics, and in one breath we say it's a commodity, and another breath I can also say that gas coming out of the Beetaloo, for example, is very low CO2 content, and you compare that CO2 content to some of our international imports that could land into Australia that have high content. It's not good for our business to be bringing in high CO2 content gas. But economics obviously play the biggest part, particularly given so much of our gas in Australia is used by manufacturers, is used by industry, and they need the lowest cost gases that they can, and we know that domestic gas is the lowest cost gas. The issue was not around price, the issue was around capacity constraints. That's what was feeding the discussion around LNG imports. LNG imports, of course, are going to be high cost gas. You've got to regasify it, you've got to transport it, you've got a foreign exchange adjustment required. Both existing pricing, historical pricing and forward pricing all tells you that domestic gas is much more affordable than imported LNG.
Adam Watson, always good to chat to you. Many thanks for your time.
Appreciate it, Ross. Thanks.
And that is it for the program this Sunday. Up next, all the latest news right here on Sky News. Business Weekend returns next Sunday, but of course you can keep up to date with all the latest business news with our daily program Business Now, 4:30 p.m. Eastern Time, and also via our website skynews.com.au. Thanks for your company today. I'm Ross Greenwood. We'll see you next week.